common view, I think the most consensus-driven view, is that it's a pro-dollar year, U.S. economy continues to grow, QE becomes less and less available. In other words, we're now in the QE removal phase, where every single month we're going to remove more and more liquidity from the market. And if the U.S. economy continues to grow at a 2.5% to 3% rate, that potentially means that interest rates will begin to lift off of the zero interest rate cycle. So that's the consensus view. And the consensus view basically then argues, and let me just go on a longer term chart here, that the trade in dollar yen is a trade all the way to 110, right? And that, I think if you have the fundamentals line up that way, in other words, we start printing 200,000 NFTs, we start doing very well in 2014. It's a reasonable assumption that you're going to have dollar yen break through this 105.50 level and establish a fresh zone at 105, 110. And the potential really for, on a longer term charts, if we go into the monthlies all the way out to like 5 years, right? You can really see that on a 5-year basis. Actually, I think we have to go to 10-year. You can really see on a 10-year basis how this 105 is a very, very key resistance level, right? Tremendous amount of overhead supply over here. But this 105, 110 was the last time we were there was pre-2008, actually post-2008 credit crunch, just sort of a bounce back on a 2008 credit crunch before we finally collapsed completely. And dollar yen then just went to a 75 low before it finally bottomed out. So for us to come back here, that would be a significant comeback. But even if we come back to the 105, 110, the really true breakout, the really, really strong pro-dollar trade would be a move above 110. It's only when we clear 110 on a very long-term basis that we have really no overhead resistance to 125 until we have the days of the carry trade. And in fact, I really don't think you can reasonably expect us to see 110 or above until and unless the market begins to price in the possibility of U.S. rate hikes. That may be middle of this year. That may be third quarter of this year, depending on how well the economy does. But it's only when the dollar becomes a carry trade again, where its interest rate actually begins to pay something against the yen, that you could potentially envision the possibility of 110, 115 in the market, right? For now, though, the really, really interesting story, the much more immediate story is 105 or 100. I'm actually kind of curious. What does everybody think? Type in whether you think it's going to be 100 or 105 first before in dollar yen. So Mike thinks 105. Anybody else have an opinion? Milan and Pan go to 100. Nick is 105. So far, it's a pretty split market. It's a pretty even market. Dishay is saying 100. And I think, what's interesting is that the view, Ramesh is at 105. The view in the room is very indicative of the view in the market. We're at a point of a pretty serious equilibrium here between the bulls and the bears. It's not quite clear that the bulls have lost, but it's certainly not clear at all that the bulls have won. Friday's non-farm payrolls, even though it was a single data point, was certainly not a pleasant data point for the market to consider. And all of the reporting from the Christmas sales in the U.S. shows that the consumer, while relatively okay, has not been extraordinarily strong. I'm sorry, hang on guys a second. I'm trying to say that. Hang on. Boris Schlossberg. Yeah, hello, Boris Schlossberg. Is this? Okay. So Dustin has or Dusty has a much more aggressive point of view. He says that the correction is already in progress, and if we don't close above 103 today, which is the 50 SMA on the dailies, then we go to 100. Maybe, I do think that if I'm going to be making bets here, and I also don't have a crystal ball, but I think the call for a correction may be quite strong. We could get a surprise in the retail sales. We could get a bump back up. But I think this 105.50 is a very, very chunky area of resistance here. And it's going to take some unambiguously positive U.S. data for us to push through. So if we get more negative data this week, I think it's easy to see us drifting towards the 100. But then having reached the 100, I do think that this is pretty serious support. At this point, then it becomes a story of really deteriorating U.S. fundamentals. In other words, yes, we can have a correction. In other words, a pause in growth, but still positive growth in Q01. And that will keep us at around 100. But if we have literally the threat of a potential contraction, the stock market starting to really sell off and having a 10, maybe a 12% correction to the downside, that kind of a dynamic definitely takes us well below 100, could possibly take us all the way out to 95, which, of course, is completely not the consensus view. This is certainly not where the market is at. The market is much more skewed to the upside. So that would actually, exacerbate the move because so many people are positioned long that if we did have a severe sell-off to the downside, that would suggest, a quick move from the 100 all the way out to 95, which I think is really, really steep support here for the move. So while the longer-term view still remains modestly optimistic, and the prospect of 105, 110 range, I think, assuming the situation in the U.S. does not get worse, is very possible as the year goes by. Because if the situation in the U.S. does not get worse, and we continue to kind of hover around these levels, the natural dynamic of the monetary policy, where the Fed takes more and more accommodation off the table, and the market begins to prepare itself more and more towards an interest rate hike, will drive us forward. But if we get to we actually start to see month-on-month declines in growth, and everybody wringing their hands, and the market selling off 10%, and the Fed seeing pressure on perhaps stopping QE taper. That is, the Fed just simply not continuing to buy bonds at a pace that they were buying. That would be all very, very negative. Abenomics not having much of an impact. I think at this point, Abe has done everything he can, or at least everything that he's willing to do, to drive the yen higher. They're not going to really expand their QE monetary policy any further than they already have. They've committed about as much capital to this idea, I think, as they want, and they're basically waiting for U.S. to pull them out. They're basically waiting for the U.S. economy to kind of be the locomotive for the global economy, and that will naturally, of course, lift dollar-yen higher through lifting U.S. rates higher, and that will naturally help the Japanese economy because it will make interest rate differentials even that much better.